Let's look at the S&P 500 first on the very short-term situation, and then we'll dial out and look at a little bit bigger picture. In that short term, we're on the bounce, the jawbone bounce from the president, with some nice words for the market and the bond market about tariffs and some backing off from his hard line, unsurprisingly. So anyway, today we had some bad news and trade-related news from NVIDIA and some other hype in the market that drove it down. It's testing support again, which held one time before, and so the bounce is still in play as long as that support holds. And if it doesn't hold, we'd be looking for a test of the lows at least before any talk of a resumed bear market. And I do believe it's a bear market. However, that is not proven yet either. So this bounce should prove out the bear market theory or negate it. I've got leg 4 of a bear market count. Not that I'm an Elliott wave person, so take that as the caveat, but these things do unfold in 5 waves, or at least they tend to. And so I stuck 4 here, somewhere below the death crossing moving averages. Talking about a death cross, if you've read me over the years, you know that itself makes me expect a bounce, because all too often that is what happens. A move in the market opposite to what the cross implies before at a later time that the cross may actually play out with more downside. But first, a bounce to screw the death cross believers. And so 4 is there. 4 could end up being here. It could make a marginal new high. Although, if we take out 2 and B here, this high on March 25th, now you're opening up the possibility that it was an A, B, C bull market correction prior to new highs. That's not the favored scenario right now. I want to take a look at the gaps, the 2 most nearby of which have filled. So that was good for the bulls. Not so good for the bulls is this gap fest down here, which I am expecting the bear market to easily take out. There's another one hiding down there. What I want to do is dial out to a bigger picture and show that a decline to this support would be basically the very clear support defined by the bottom and base coming out of the 2022 market correction. That would be a minimum for this bear market, and it would just be a cyclical bear, something pretty small, pretty tame. However, I believe a bubble is bursting, and I want to get rid of, if I can, some of this noise in the chart. There we go. And I'll get rid of those moving averages and clean this up. I believe a bubble is bursting, not for reasons of this chart. This is an intact mega bull market. High, low, high, low, high. And, we could get a hard bear cycle, make a higher low to the 2022 low, October 2022, and that keeps the big bull market intact. Much like 2022, which people called a bear market, was just a correction way above any levels that would have compromised the major long-term trends. So we do, I notice, have a very nice negative divergence of a longer term on RSI. Here, here, here. That's interesting. It's a market that on the big picture is fading momentum. So this is this is the Armageddon point here. Make a low below 3,941 and this thing would be in deep trouble. I am not projecting that at this point. I do want a good severe bear market to clean the pipes at least. And that would be ideally down here to around 4,000, 4,100, the top of that pattern right there. Break this here, and now you're talking something terrible. And to me, since I think we're in a post-bubble environment, that's not off the table. Let's wrap her up here. Hopefully that's a little perspective on the SPX, and we'll talk again.